So, you're thinking about investing with Nutmeg, huh? Good choice. But before you dive headfirst into the world of stocks, bonds, and ETFs, let's talk about something crucial: risk. Yeah, that scary word that everyone loves to avoid. But let's face it, investing without understanding risk is like driving without a seatbelt, not smart. Now, I know what you're thinking. Risk? Isn't that just a fancy word for losing money? Well, not exactly. Risk is more about the potential for loss compared to the potential for gain. It's like a roller coaster. The higher the drops, the more thrilling the ride, but also the scarier. And when it comes to investing, that roller coaster is the market. Nutmeg, like many other investment platforms, offers different risk levels. There's cautious, steady, balanced, growth, and adventurous. But what do these labels really mean? Are you going to get rich quick with adventurous, or are you better off sticking to cautious? Let's break it down. First off, it's important to understand that higher risk generally means higher potential returns. That's the whole gamble. But it also means a higher chance of losing money. So, before you pick a risk level, ask yourself, what's your investment goal? Are you saving for a house in 5 years, or are you planning to retire in 2 decades? Your time horizon plays a huge role in determining your risk tolerance. If you're young and have plenty of time to recover from market downturns, you might be more comfortable with a higher risk level. But if you're closer to retirement, you'll probably want to play it safe. It's all about balance. Now, let's talk about how Nutmeg actually manages your money based on your chosen risk level. They use a mix of different investments, like stocks, bonds, and cash. The higher the risk, the more money they'll allocate to stocks, which have the potential for higher returns, but also higher volatility. On the other hand, a lower risk level means more money in bonds and cash, which are generally considered safer but offer lower returns. But here's the thing. Past performance is not indicative of future results. Just because a high-risk portfolio did well in the past doesn't mean it will continue to do so. And a low-risk portfolio might not always protect you from losses. That's why it's crucial to diversify your investments across different asset classes. Nutmeg does this for you, but it's still important to understand the risks involved. Another factor to consider is your personal financial situation. How much money can you afford to lose? What are your other financial obligations? These questions will help you determine your risk tolerance. So, what's the bottom line? There's no one-size-fits-all answer when it comes to risk level. The best approach is to carefully consider your financial goals, time horizon, and risk tolerance. Nutmeg's risk assessment tool can be a helpful starting point, but it's important to do your own research as well. Remember, investing involves risk. There's no guarantee of profit, and you could lose money. But with careful planning and a long-term perspective, investing can be a powerful tool for building wealth. With that said, thanks for watching, and until next time, happy investing.